As a shareholder, you expect the companies you invest in to create value for you. But how do they do it? By growing and earning a return on capital that's higher than its cost. Seems simple, right? But the key lies in the approach. Short-term gains are tempting, but if companies become overly focused on them, they often end up making decisions that hurt their long-term prospects. Take, for instance, cutting back on marketing spend or any other value-creating activity, like R&D. It may give a little boost to the bottom line in the current quarter, but it could also slow down future growth and value. It's crucial to maintain a long-term perspective on value creation and not get bogged down by short-term performance metrics, like EPS. After all, your investment is much more than just a series of quarterly earning reports. It's about investing in a company with a vision for the future. The consequences of forgetting or deliberately neglecting fundamental principles of value creation can be catastrophic on both economic and social levels. A prime example of this occurred during the global financial crisis of 2008 and 2009, where the exuberant and unsound behavior of many financial industry participants before that ultimately led to the largest recession since the Great Depression. Similarly, the start of the millennium saw the infamous internet bubble and subsequent dot-com crash, where a significant deviation from value fundamentals and exuberant valuations led to massive value destruction. These crises highlight the importance of adhering to fundamental principles of value creation, which can help to avoid value destruction and promote healthy economic growth. If a company wants to consistently create value, then it's crucial for them to sustainably grow at sufficiently high rates of return. This ability hinges on a company's competitive advantages and how long they can maintain them. Inevitably, competition will arise and erode a company's sources of competitive advantages. To combat this, a company must be proactive in seeking out and utilizing new sources of competitive advantage. In this lesson, we'll delve deeper into the various sources of competitive advantage and explore how companies can leverage them to achieve sustainable returns. Return on invested capital is a crucial metric that connects a company's profits to its invested capital. The goal is to generate more profit with the same amount of investment or generate the same profit with less investment. This measure offers insight into a company's profitability, industry structure, and competitive dynamics. When a company consistently earns a higher return on invested capital than its cost, it creates more value. Also, consistent above-average returns on invested capital can indicate a company's competitive advantage in comparison to its rivals. This is a valuable metric for determining a company's potential for long-term success. The profitability of a company is largely influenced by the industry in which it operates. Some industries call for greater investments, and their products are largely commoditized, such as in mining. Consequently, it's difficult for any firm to maintain a competitive edge and earn high rates on their invested capital. However, some industries provide greater opportunities for companies to earn higher returns on invested capital. Branded consumer goods are a great example of such industries. Firms can leverage the power of their brand name to offer products at premium prices, which, in turn, help them boost their earnings. By investing in a powerful brand, these companies can enjoy higher profitability, giving them the resources to further invest in their products and delivery, resulting in sustained returns over time. How long can a company maintain above-average returns? Ultimately, it comes down to a few key factors, such as the length of a product's life cycle, the unique nature of a company's business model, and the ability to regularly renew products and services. Products with long life cycles tend to attract loyal customers, increasing their value to a business. Customers locked into products with long life cycles are much more valuable. Also, businesses with easily copied models often face increased competition, reducing any competitive advantage they once had, irrespective of how innovative these business models might be. In these situations, any benefits for a company will be short-lived and will typically be passed on to end users. Finally, the ability to renew businesses and products is key for long-term success. As mentioned previously, companies with strong brands are well positioned here as they can leverage their brands to continuously come up with new products or even venture into new categories. Once achieved, companies are usually able to sustain high rates of return on invested capital. McKinsey shows that while there is some reversion toward the industry mean for the best performing companies, these companies are usually able to sustain their competitive advantage over time and earn above average returns on invested capital. This has also a practical implication when valuing such companies. When calculating the terminal value for these companies, it's then fair to assume their return on invested capital above the weighted average cost of capital for the industry in which they participate. Now, let's see what are those sources of competitive advantage that allow companies to deliver elevated rates of return on invested capital. McKinsey groups them into three categories: those that allow the companies to charge a price premium, those that allow better cost and capital efficiencies, and those leading to network economies. For a company to be able to sell its products at a premium, these products must be differentiated from those of its competitors. While difficult to achieve, once so, product differentiations are usually the most durable sources of competitive advantage that allow for extraordinary returns on invested capital. These may be one or more sources of such differentiations, including brand, quality, innovations, customer lock-in, and others. Cost and capital efficiencies relate to advantages a company has over its competitors in terms of either being able to deliver products at lower costs or its ability to deliver more products per unit of invested capital. These can come from innovative business models, access to unique resources due to geographical proximity, scalable products, and similar. Ultimate success can occur if companies can achieve network economies and increase returns with scale. In these situations, the products get more valuable to customers with their increasing adoption, while cheaper for the company to deliver. Thus, both price premiums and cost advantages can be achieved at the same time, leading to increasing returns. A strong brand portfolio can be a significant source of competitive advantage, especially for companies competing in consumer goods categories like beverages, cereals, or durables. Take for instance Coca-Cola, Mercedes-Benz, or many brands from consumer goods giants Nestlé or Procter & Gamble. These are all household names, associated also with quality that are deeply engraved into the consciousness of millions and across generations. As such, these companies are able to not only sell branded products at a premium, but also to successfully leverage those brands time and again when launching new products and categories. Their brands are a source of durable competitive advantage for those companies, adding to their potential for renewing businesses and products. Innovative products work best if difficult to copy or when protected by patents. Absent patent protection, or if easy to copy, any innovation will be short-lived as competition will quickly catch up and render insignificant any differentiation such innovative products might offer. Pharmaceutical companies invest billions of dollars each year in research and development to discover new drugs and treatments. One way these companies can benefit from their investment is through the protection of patents. Patents allow pharmaceutical companies to have exclusive rights to produce and sell a drug for a certain period, allowing them to charge premium prices for the drug. For example, Johnson & Johnson spent $14.6 billion on R&D only in 2022. One of the patents in the past from which Johnson & Johnson was able to benefit greatly was that for its blockbuster drug Remicade, which treats rheumatoid arthritis, Crohn's disease, psoriasis, and other autoimmune diseases. The patent was granted in 2001 and allowed Johnson & Johnson to have exclusive rights to produce and sell Remicade for almost 20 years, allowing them to charge premium prices for the drug during that period. Patents are an important part of the pharmaceutical industry as they provide incentives for companies to invest in R&D while also protecting their investments from competitors. This allows pharmaceutical companies to reap the rewards of their investments while also providing patients with access to life-saving drugs. Customer lock-in is a situation in which a customer is so dependent on a vendor for products and services that they cannot move to another vendor without incurring substantial switching costs. This can be achieved through various methods such as offering exclusive features, creating proprietary standards, or providing incentives for customers to remain loyal. The benefits of customer lock-in for the incumbent company include increased profitability and customer retention, with customers often paying a higher price for their products compared to competitors. Microsoft Windows operating system is an excellent example of customer lock-in due to several factors that make it challenging for users to switch to an alternative platform. These factors have allowed Microsoft to maintain a dominant position in the market and enjoy increased profitability, customer retention, and higher pricing for its products. Widespread adoption. Windows has been the most popular operating system worldwide for decades, with an extensive user base across various industries and segments. This widespread adoption creates a network effect, where more users and developers are attracted to the platform due to its popularity. Compatibility and integration. The Windows operating system is compatible with a vast array of software applications and hardware devices. Users have grown accustomed to using specific tools and applications that may not be available or function differently on other platforms. Additionally, many businesses rely on Windows-based software to run their operations, making it difficult to switch without significant disruption and cost. Familiarity and ease of use. Over the years, users have become familiar with the Windows interface and its features. This familiarity reduces the learning curve for users when adopting new versions of Windows and makes it less likely they'll switch to a different operating system, which may require relearning navigation and functionality. Proprietary standards and file formats. Microsoft has developed proprietary standards and file formats for its products, such as the DocX format for Word documents and the XLSX format for Excel files. These file formats may not be fully compatible with other software, creating a barrier for users who want to switch to alternative platforms. Ecosystem and vendor lock-in. Microsoft has built an entire ecosystem around its Windows operating system, including Office productivity tools, Microsoft Office, cloud services, Azure, and even hardware devices, Surface. Users who have invested in these products and services may find it more challenging to switch to another platform without losing access to the tools they rely on daily. Support and updates. Microsoft provides regular updates, security patches, and support for its operating system. Users feel more secure, knowing their system is up to date and well maintained, making them less likely to consider alternative options. Incentives and discounts. Microsoft offers various incentives and discounts to maintain customer loyalty, such as discounted pricing for volume licensing, educational institutions, and non-profit organizations. These incentives make it more attractive for customers to remain with Microsoft rather than explore alternative solutions. Cost and capital efficiencies are sometimes possible due to a company's innovative business model. Tesla, for example, is in a league of its own among automobile competitors when it comes to operating margins. The secret? Innovation not only in its production, but also in their go-to-market strategy. Unlike other car manufacturers, Tesla sells their cars directly to customers online, cutting out distributors. This strategy leads to better operating margins and an edge over the competition. Cost and capital efficiencies can also be extracted in situations where a company has access to unique resources or due to geographical proximity. For instance, the proximity of Australian iron ore mines to China as the world's largest consumer of iron ore gives an advantage to Australian mines versus the Latin American mines. The significantly shorter distance to China eliminates a lot of transportation costs for Australian mines versus its Latin American peers, thus making their profitability and rates of return higher. Finally, scalable products can also reduce costs and capital intensity. Most software products fall into this category. Most of the related costs come up front and during the product development phase. But once a company starts selling these products, each incremental sale comes with very small incremental costs. The more product the company sells, the better the return on investment. Microsoft and its suite of widely spread software products are again a very good example here. Creating value through growth is only worthwhile if the return on invested capital exceeds its cost. The greater the difference between the return on invested capital and the weighted average cost of capital, the more valuable revenue growth becomes. Typically, companies with a high return on invested capital should focus on increasing revenue to enhance their value. Conversely, companies with low returns on invested capital may improve their value by prioritizing profitability and capital efficiency. However, there are different types of growth, and they're not all the same when it comes to value creation potential. One can classify growth into organic and inorganic. The former can either be because of market share movements or portfolio momentum, and the latter is due to mergers and acquisitions. Inorganic growth can further be divided into bolt-on and large acquisitions. One of the most effective ways to generate growth and create value is through portfolio momentum. This involves introducing new products to the market, increasing sales of existing products to current customers, and attracting new customers. By leveraging existing operations, companies can deliver new products with minimal upfront investments, while also minimizing the risk of retaliation from competitors. Overall, this type of growth strategy offers the greatest potential for extraordinary returns and is typically the most effective way to create value. Looking at the opposite end of the spectrum, we have growth through market share capture. This kind of growth tends to provoke robust competitive reactions, particularly in industries with established players experiencing slow growth. Unfortunately, this type of growth usually presents the least opportunity for creating value, as any benefits from capturing market share tend to dissipate quickly. Ultimately, the only real beneficiaries of this kind of growth are consumers who get to enjoy lower prices. The potential for creating value through acquisitions is somewhere in the middle. Generally, bolt-on acquisitions offer more potential for value creation as long as the premium paid for targets is reasonable. These types of acquisitions add to the acquiring company's business model in small increments and come with less complexity and integration risks. However, large acquisitions are more challenging to execute and come with significantly greater implementation risks. As a company grows, sustaining high revenue growth becomes increasingly challenging. This is particularly true if the product markets in which the company operates are not expanding rapidly. Typically, companies experience higher growth rates when they're new to the market and have a small revenue base. However, as they expand, it becomes significantly more difficult to generate new products and projects to maintain the same level of growth. Rapid growth may be achievable in the short term, but maintaining consistently high and above average growth is not sustainable in the long run. The slowdown in revenue growth rates can be attributed to the natural life cycle of products. Generally, these cycles follow a typical S-curve, with sales starting off slow as early adopters test the product. Once proven successful, the product enters a high growth phase, reaching its peak. Eventually, the growth slows down as the product fully saturates the market, and from there on, growth rates are similar to those of the long-term growth rate of the product markets. In some cases, product revenues may even decline or disappear altogether if the product is disrupted. As we've seen, achieving growth and return on invested capital are both vital for creating value. A valuable lesson is that if a company is already experiencing high returns on invested capital, then it should focus on growth to generate even more value. On the other hand, if the returns on invested capital are low or below the cost of capital, then the focus should be on profitability and capital efficiency to increase the return on invested capital. Also, we've learned that it's much easier for a company to sustain high returns on invested capital than it is to sustain high revenue growth rates. As companies grow larger, launching new products and entering new markets becomes increasingly challenging. In fact, it can be practically impossible to do so successfully. The growth that was once inevitable begins to decay with size and converges to the long-term growth of the product markets. This often results in these markets becoming more similar to the growth of a broader economy or population. Thus, unlocking maximum shareholder returns requires understanding the principles of revenue growth and return on invested capital. Companies can make better decisions to create value by focusing on these factors. And don't forget to keep a long-term focus while doing so.